Well, Dream. Hello, Jason. You have had quite a busy week. Can you tell us what you've been up to?
Well, I have been masterminding all week, and it has been just so fun. I mean,
I heard you were rubbing elbows with some celebrities.
yep. Ice baby ice,
Yeah, Ice Ice Baby.
vanilla ice, but a lot of celebrity business people who are friends of mine. But yes, we had vanilla ice come on the last day of this mastermind event. I'm here in Tampa, Florida, and I want to tell everybody that one of the fastest accelerators of success is the mastermind group. It is really, really just the thing to do if you want to grow, if you want to succeed, if you want to make new contacts. Just really, the without a doubt, the most valuable thing I've ever done is join mastermind groups, and I'm in four of them now. I also have my own mastermind group, as many people know. That's called the Collective. I do that with Ken McElroy and George Gammon. And I had another mastermind group that I ran for about 5 years called the Venture Alliance Mastermind. And there is just something about a mastermind group that is so effective. Back in the old days, Napoleon Hill, the author of Think and Grow Rich, talked and wrote about the value of a mastermind a lot. And he was right. It's just an incredibly valuable thing. I think, Ashley, one of the things that's so valuable about it is you make the people in the mastermind group your friends. They
Mhm.
become the people you do life with, right? And you have all these shared experiences that are the stock and trade of friendship. And you see each other at least once a quarter. Now, this particular mastermind that I was at this week, we have Zoom calls every other week also. And then, well, we don't see each other quarterly in this one. We have two live events per year, so every 6 months, but Zoom every other week. But most masterminds have this quarterly format. That's the one I like. That's the one we use for the Collective, and I did before with the Venture Alliance Mastermind. And so it's unlike when you go to a conference, you meet someone maybe once, maybe you have that conference again and bump into each other a year later or 2 years later. But this is just a much stronger bond. So very, very powerful. It's just been an incredibly valuable week, an incredibly fun week. All of the dinners and all of the drinks and all of the shenanigans. Really. So it's just been a great week. And tonight I fly to Salt Lake City. I've got a speaking engagement to a group of fund managers in Park City, and that's going to be, I think, a great time. 3 nights there, and then to Scottsdale for Ken McElroy's wedding reception. And I've got a whole bunch of people to see in Arizona because I lived there for 6 years. So
Wow.
a lot of friends there, a lot of people to see, and that's what I've been up to. So I really want to recommend that to everybody.
That sounds great, right? Because no man is an island. So if you are, you're making contacts not just for business, but for life. You're surrounding yourself with like-minded people, and that's extremely powerful and empowering as well.
Absolutely. One of the important things about this, and it doesn't have to come just through a mastermind group. Of course, it comes through just friendships and connections, but a lot of success in life really does boil down to luck. Look, whether you believe in luck or not, that's not really the point. But certainly, some people are fortunate enough or lucky enough. Earl Nightingale used to say, luck is what happens when preparedness meets opportunity. And I really like that saying because everybody will have certain fortunate or lucky events in their life, but it will make the unprepared look foolish, and the prepared will be able to seize the opportunity.
Mm.
So when you're in a mastermind group, you can kind of force luck. You can push lady luck along a little bit, right?
Hmm.
And it's not about the how always in life. We all try to increase our skills, hopefully, increase our education, and learn how to do things. But the shortcut is not the how, it's the who. And someone else may have spent their whole life developing the connections you need, or the knowledge you need, or the skills you need. And instead of learning them yourself, you can just have a friend who has all those connections, who can open doors for you. And I think that's one of the reasons it's so incredibly powerful. So if you're not able to or wanting to join a paid mastermind group, like a commercial mastermind group, like the one I run, then just get an informal one going with people you know. But don't necessarily choose your friends. Don't necessarily choose your friends. Choose the people who are strategic. In life, most of us just have our friendships by default. We just, whoever happens to live close to us, or whoever we happen to meet. And, you might have some lucky friendships there that turn out to be really valuable. But most likely, that's not going to be the case. You've got to do this somewhat strategically. And some people might think, well, that's lame. What aren't these don't sound like true friends to me. Well, you're wrong. That's not true at all. Because people you want to meet strategically are true friends to some people, right? You just don't know them yet. You're not in their circle of true friends, right? And they could be a true friend to you, right? So this isn't like some plotting social climbing thing. It's just a smart thing. It's an awareness rather than, like so many people in life, they have this idea that you need to be friends with the people you were friends with in high school. Why?
No.
Why? Where did that idea come from?
But you can also grow and move beyond that circle.
Absolutely. Absolutely.
That's interesting. You said that the shortcut isn't how, but who. That's really interesting.
Absolutely.
And one of our audience members who's joined us this morning and made a comment, Ramesses Goucher, sorry for the pronunciation, says, a few fellow real estate investors and I are starting our own mastermind group. Absolutely excited. You having 4 makes me want more now. That's amazing.
Good stuff. Yes, absolutely. Now, what is the you having 4? I'm not sure what you mean.
You are part of 4.
Part of 4 masterminds. Yes.
Part of 4. Some of them are your own, and then you're part of some others.
If you think about this, it's not as popular now, but certainly in maybe the 60s, 70s, and 80s, if you look at old movies, old TV shows, the thing people did is they joined a country club. Right. And I was a member of 2 different social clubs, city clubs, they call them, not without golf. But back when I lived in Orange County, and, that's great. And the reason people do that is because they can socialize with people who are upwardly mobile or already, up, I'll say. But with a mastermind group, it's more targeted on your specific business or industry, and just incredibly powerful.
Right. And how much you're going to learn about other industries and that you might not have really done a deep dive into. And that is no doubt going to come back to you tenfold.
Yeah. Not targeted enough at the country club. It's not bad. It's better than nothing. It's better than the default thing. But again, you want it to be more targeted. And when it's a commercial mastermind group, the person running that group makes a specific effort to help people make connections and to help everybody move their life and career along faster. And so, for example, in the collective mastermind, when I was working on setting that up with my partners, I had this idea that we should have a formal role for an employee. And I gave that role a name. I called it the connection concierge. And that person's role is to connect people, to think of ways people can connect, not just leaving it to chance like, hey, you're interested in real estate investing in apartments and single family homes. Maybe we should talk sometime. The members will say that to each other at the events, right? But really, this connection concierge is constantly thinking about the different members and what they know about the members, and making introductions very intentionally. So very powerful as a
That is very
commercial.
powerful to have someone whose specific role is to facilitate those connections.
Absolutely.
Yeah, that's
absolutely. Yeah. Good stuff. Well, that's what I've been up to. And, got another week of travel, and I'm already wanting to get home, I have to tell you.
But that sounds very exciting to be in Park City, Utah, and speak.
Beautiful place. And this time of year, I can't wait to see some fall leaves, because a friend of mine just called me from Aspen, who has a home in Aspen, and said that the leaves are changing and it's like peak time already. So I just love that. Is that happening in New York, Ashley?
It is not. This year was a very strange weather year. Of course, I missed it all. I was somewhere else this summer.
Yes.
But
you
now
were on a gig, a singing gig.
The colors are coming in just now. I took a nice drive yesterday, actually, up into a little, upstate New York, and it's not as good as other years, but they are coming in. They are coming in now. This next week is probably going to be the peak time for the colors. Yeah, it's my favorite time of the year.
Yeah, it's one of my favorite times.
I've never seen New England in fall. It's worth a trip. Yeah, Massachusetts, Vermont, New Hampshire, New York.
Absolutely. We did a cruise for my Venture Alliance Mastermind 2 years ago, and it was a fall foliage cruise. And there are these websites you can go look on and see the fall foliage.
That's
that's cool.
Yes.
I have to tell you something before we get on to real estate, and we are going to talk about that. It was so cute. You made me think of my late grandmother, who lived in upstate New York. And she would always send me a birthday card with a cute little check in it for maybe $5. Right? And she would send me leaves in the card of the foliage changing, because I lived in Southern California and we didn't have that, right? And so she would always send me those leaves in her cards. I still have some of them with those old leaves. So yeah, that's
cool. Really nice. Well, hey, $5 and just adjusted for today's inflation rate it's not bad. It's not a bad gift.
See, folks, Ashley knows what she's talking about here.
Not really, but I'm here to learn, just like everyone else. Isn't that a spectacular thing? There's never a shortage of things in the world to learn about.
I'm glad you caught that one. $5 adjusted for inflation. We'll do that. I'll do that for maybe the next show. And by the way, time permitting today, I do have to go meet some people and grab lunch and look at some properties, but I did pull up a couple of new inflation calculator charts this morning. Time permitting, I'll share those with everybody. So
absolutely, yes. So if you're joining us today, just now, thank you so much. We have some all-nighter hider, raw mean.
All-nighter hider is back.
Yes. Hit that like. Yes, please hit that like button, subscribe, get notifications. Jason has a lot of material all the time, and you don't want to miss any of it. So speaking of birthdays, can we talk about another really important thing before we jump into some questions?
Go for it. You want to talk about the contest?
Yes, I would love to.
Okay.
So in honor of Jason's birthday, which is I'll just say it's imminent. It's on the horizon. If you reached out, you could touch it. It's that close. We are hosting a birthday contest, and you definitely want to participate in this, because Jason is much more generous than your government. So the percentage of you winning and getting a great prize is much higher than your percentage of being helped by your government. So, however, you will have to do something in order to win. We would like you to make a video, and we would like you to talk about your long-term investing goals, how real estate is going to help you get there, or has helped you achieve thus far, and what you're doing on a daily basis, a weekly basis, a monthly basis to keep improving your education, your financial education, and your real estate investing. And we have great prizes. So 2 grand prize winners will win $500 each.
Yeah, and I put it up on the screen. Ashley, do you see that, by the way?
I do, yes.
Okay, so you go to jasonhartman.com/contest, and Ashley is going to give you some instructions right now. But yeah, $500 for the 2 top winners. But Ashley, Are you going to tell them how they can double their money?
Yes, I am. Well, if you win the contest and you've closed on an investment property with Jason and his team in 2021, your winnings will double.
Yes.
So who doesn't want $1,000 cash in their hand right now? So
Absolutely. So you have to obviously win, but if you purchased a property through our network and closed this year, you'll double your prize. So you'll either double your cash prize if you're one of the 2 top winners. Instead of getting $500, you get $1,000 prize, or you get double the gadgets. So we've got some gadgets down below: the Amazon Echo, Kindle, Ring doorbell, and those are really cool gadgets. Of course, I have them all, and a lot of people do, but maybe you don't have the latest model of those things. So those are available. And Ashley, tell them about what they need to do.
So we'd like you to make a video, 3 to 5 minutes, no big deal. Can be, if you want to pull out all the stops, that's great. If you want to make a basic video with your cell phone, that's even better. It's up to you.
Gritty is okay.
Real world, raw, it is what it is. And cell phones make great videos nowadays. So
they sure do.
Everyone has the capacity to produce a short video. Tell us about your goals. We'd like you to upload it to YouTube, and using the term Jason Hartman birthday contest in the title. And you can put some hashtags Jason Hartman on that as well. And we will choose winners based on quality and content, as well as legitimate YouTube likes. So feel free to share it with your circle, with your friends, with your family, because it's not the how, it's the who we just established. So put those goals out in the universe. And as James Allen would say.
Yes. Oh, wow. James, did you read As a Man Thinketh?
I did. Yeah.
Oh, that's such a great book. I read that at like 17 years old.
Yeah.
Yeah, that's a great book. So a book recommendation right there from Ashley, folks. As a Man Thinketh by James Allen. It's great. It's a tiny little book. It's an old book, but it's brilliant. You
can read it in 1 hour. Mm-hmm.
Yeah.
All right. Yeah. So that is the birthday contest.
Okay. So let's tell them what the video needs to be about, though, a little bit. Mm-hmm. So the video can be about kind of anything. We wanted to just leave it open for you. You can talk about your 5-year plan with your investments, how you plan to reach your goals with real estate investing. You can talk about some of the teachings that I've shared with you over the years that have been meaningful to you. Whatever you want. It's really, you can just talk about your story, how you started investing. I mean, we've had clients that have been investing for years with me and my team, and you could talk about that story. Whatever. We just kind of want to leave it open, but with a focus on real estate and mindset and income property and so forth. So just a quick video, could be 3 minutes, 4 or 5 minutes, no big deal, and just get likes and views and good content. Yes, and even if it's gritty, it doesn't have to be high production quality, no cinematography needed. But hey, if you do that, all the better.
Right. But the sky's the limit in terms of content. We just want to hear from you.
Yeah, absolutely. So you just submit that video, put it on YouTube, submit it at jasonhartman.com/contest. And I think we're going to wrap that contest up in about 7 days. October 10th is our target date. So get that done. And by the way, Ashley, you know what? I'm going to let them all in on a little secret here. Ready, folks? Not a lot of people enter these contests. So your chances of winning are extremely good. In fact, maybe we should let them in on another secret, Ashley. I know someone with us who won our last video contest.
Yes, I also know that person. Yes.
Because it's you.
It was me. Yes, I did.
Yes. You and one other. We had 2 winners for that, and you were one of the winners, and that's how we met. So that was really cool.
Yes. And that was a very pivotal point. Absolutely, for me. Absolutely.
Yeah. Good stuff. Okay. Well, hey, so everybody enter the contest. That is cool. And Ashley, want to start with this one?
I do. Yes,
Yeah.
absolutely. From Scott Wang. Jason, if housing is cheaper than the S&P 500, does that prove that real estate is a worse investment than stocks?
Oh, that's interesting. No, it does not. And I will tell you why. I'm going to actually pull up that chart that you're referring to because you must have seen that at either our live conference or one of my other speaking engagements or on YouTube. And I'm looking for the chart right now. So, first off, I'm going to talk about the price of the house as soon as I can find that chart. And I will have it here in a jiffy. And 2 shakes of a lamb's tail here, folks.
Now, is that nominal price?
Ashley knows what she is talking about there, folks. Nominal versus real. But we also want to talk about the house payment, not just the house price. Okay, so let me share this. It's a lot harder to do this with one screen. I'm in a hotel room, obviously, here in Tampa, and without my dual monitors, this gets much harder to share screens. So let me figure this out here.
While you find that, so we have another comment. Darren Harvey, he wrote, I helped develop a collective of advisors, mentors, if you will, from former current clients that are successful developers and executives, in that I can seek counsel, sometimes just ask. That's great, Darren. Yeah. Nicely done. Yeah. See, there's another example.
Excellent example, Darren. That's great. Okay, so I'm going to take Scott's question off here just so I can show this chart. So here is the slide, okay, that you're referring to. So first off, we're going to talk about the price of the house, but then we're going to talk about the payment on the house. And we're, of course, going to talk about inflation and which one's the better investment and so forth here, because it's a good question. So let's go back 51 years ago to 1970. The median house price is $22,600. One share of the S&P is $93. So it'll cost you 243 shares of the S&P to buy a house. And the whole premise of this, the Hartman Comparison Index, is based on using multiple measuring sticks. Most people make a huge mistake because they're only using one measuring stick, the US dollar, and that is a huge flaw in thinking. You can make a lot of bad decisions by doing that. Let me just clean up this screen a little bit here by getting rid of that. Okay, much better. So you don't want to do that. You want to use multiple measuring sticks. So fast forward 10 years, 1980, the house price has tripled in dollars. The S&P has only gone up a little bit in dollars. So 10 years later, it's much more expensive to buy a house in shares of the S&P. It's almost 3 times as much, right? Because, about 2.5 times. 243 shares of the S&P would buy you a house in 1970, but now it's going to cost you 626 shares in 1980 when Reagan comes in, our greatest president ever, by the way, or at least in modern times, our greatest president. And then go to 1990, the peak of civilization, as I always say. 1990 was the peak. It's all been downhill since then. And in dollars, the house price has almost doubled. It's now 121,500. S&P shares have tripled almost, or more than tripled. And now it's only going to cost you 338 shares of the S&P to buy a house. More expensive than it was 20 years earlier, but less expensive than it was 10 years earlier, right? So we all got that. Now let's go another 10 years to 2000. The house price went up about 50 grand. It's now 172.9 in dollars. S&P shares have gone up a whole bunch. Wow, good run for the S&P.
Yeah.
$1,455 for one share of the S&P. So now it's only going to cost you 119 shares to buy a house. So let's go another 10 years. 2010, the house price goes up about another $50,000. S&P shares go down in value vis-a-vis the dollar and the house price. So it's going to cost you now almost double the number of shares. I mean, not quite. 198 shares of the S&P to buy a house in the year 2000. Okay. Oh, wait. No, that's 2010.
Mm-hmm.
Which one am I doing? I'm doing... Which one was I on, Ashley? 2000? What?
2010.
Okay. So 198 in 2010 because the S&P shares went down vis-a-vis the dollar. Mm-hmm. So let's just go to today. We don't need to bother with 2020 because it's close enough. We're only a year off. So by June of this year, the house price is about $348,000. S&P shares are way up. You pump a bunch of fake dollars into the system and everything's going to go up as it did. We all saw that with the pandemic. We've got $4,352 for a share of the S&P. Only 80 shares of the S&P will buy you a house. Note that that's cheaper than it's been at any time in 51 years.
Yeah.
In shares of the S&P, but more expensive in dollars than it's been at any time in the last 51 years. So the question is a good question, but it doesn't tell you the whole story. Why? Because remember, the returns on the S&P, if they average about 8 or 9% a year, that's what people will tell you, okay? That the S&P will average 8 or 9% per year, but real estate will only average about 6% per year. So you would think from a very novice view that the S&P is outperforming real estate, but that is wholly false. Now, Nobel Prize winning economist Robert Shiller, who has the lousy Case-Shiller Index for home prices and wrote a couple books entitled generally Irrational Exuberance and Irrational Exuberance 2, completely misleads people on this. It's absolutely wrong what he's doing. Jim Cramer, the Mad Money guy, he misleads people on this too, because the reality is almost nobody buys a house with cash. And if they do buy it with cash, they don't continue to own it with cash. They refinance and pull the cash out, as I recommend in my Refi Till You Die strategy. So what happens then? Well, say you finance that house and say it's an owner-occupied house. So you put 10% down on that house. Well, you take that 6% return and you multiply it based on the leverage. So that 6% return turns into a 60% return with the leverage, with the mortgage on the property. And that S&P return does not increase. So the answer to the question is, historically, you would have been better in the S&P 500 than in dollars. Now, not always, because it depends what exact time period you're talking about. But looking at our chart, you can see that if you compare dollars to the S&P 500, the dollars have been lousy. The S&P outperforms the dollar, okay? But it does not outperform the property because you're going to leverage the property. It's the most debt-friendly asset class in the United States. And Ashley, if you're ready, I will switch to the mortgage payment discussion because that goes into this. But do you have any thoughts, or are there any questions coming in you want me to answer while I'm?
No, you stay on. Yeah, stay on this and go over to the mortgage slide. Yeah. Okay. Absolutely.
So
that question, Scott.
We want to go to this one. Come on. Oh, darn it. Okay, so it's not about the price, it's about the payment. So let's find the S&P comparison here.
Paul Niederreiter says multiple measuring sticks provides multiple perspectives.
Absolutely.
Yes.
Absolutely. Very good thing. Okay, can you see the mortgage payment one now, Ashley?
No. Oh, yes, I can. Yes.
Okay, good. So now let's look at paying the mortgage on the property. We're not talking about...
I can't see it. No,
you can't.
Stop
What the heck is going on here? What the heck is wrong here, folks?
We're still on the S&P
Ah,
500.
yeah, it's
There you
not. Boy,
Okay.
this gets really weird when you're doing it with one screen. Yeah, we even do the prostitution index that the economists publish. Here's
Service.
the haircut index. Yeah, I know. It's from
Okay.
no less a reputable source than the Economist magazine, folks.
Mm-hmm.
Okay, all right. Can you see it now?
Yes, there it
Oh,
is.
good, good. And is it full screen? Yes, it is. Okay, great. Okay, so now we're talking about making the monthly mortgage payment on the house. In 1970, if you want to pay your mortgage in shares of the S&P, 1.5 shares. By 1980, remember, vis-a-vis the dollar and the house, the S&P performed poorly. So 5.3 shares in 1980 costs a lot more to pay that mortgage payment every month. And then it went down, and today only 0.3 shares of the S&P will pay your monthly mortgage. So here's the takeaway, okay, because this is a very good question our studious follower asked. The takeaway here is, if you're saving to buy a property, when you get your cash, convert it to something outside of the dollar, like in this example, maybe shares of the S&P, or maybe gold, or maybe something else, right? And there's a lot of things in the Hartman comparison index that we talk about. But the point is, the dollar almost always performs very poorly because of inflation. And that's why you want to convert it. But then when you're ready to buy the property, you convert it back to cash to convert it to a down payment to acquire the property. So you save it outside of the dollar, but then you do the conversion, convert it back to the dollar, and then convert it back to a piece of real estate.
Mm-hmm.
And that's how you're going to do the best. But if it takes you 10 years to save, or 3 years to save, or whatever, you're likely going to do poorly if you save in dollars. That is one of the major takeaways. Of course, this is nuanced. There's more to it than that, but that's the basic idea. I hope that makes sense.
Right now, in this particular environment.
Right. Absolutely.
Maybe in the 90s, it was different.
Yeah. It's always different. It changes all the time.
Yeah.
Okay.
Get quite a good interest payment on a savings account or something like that. Those days are long gone.
Right. But Ashley, though, even though you say that, right, I remember my mom telling me about how she used to get 16% interest in a Dean Witter money market fund. Okay, and that was great. But guess what? The inflation rate, the official inflation rate at that time, was 13.5%.
Okay,
so she's still ahead in that example, but the real inflation rate was probably much more than 13.5%. It wasn't as heavily manipulated, the consumer price index back then, but it was still manipulated nonetheless.
Mm-hmm.
And so,
yeah. Sure. So things are not always as they seem. They're not always what they seem, which is why multiple measuring sticks provides multiple perspectives.
You got it.
Okay, let's go back to a question 1112 from Raw Mean.
Okay. I'm looking.
Raw Mean. So one of the first questions asked.
Coming up.
So
there we go.
What are your thoughts on rent to owner ratios when evaluating rental markets to invest in?
Oh, good question.
We talked about that last week a little bit.
Yeah, absolutely. So I don't think you mean rent to owner ratios. Hopefully you mean rent to value ratios.
Mm-hmm.
So the rent to value ratio, I have long targeted 1% per month, meaning just for round numbers sake, if it's a $100,000 house, you want to get $1,000 a month. Was the ideal metric. And you could, if you liked the deal, go down to about 0.7. Meaning for every $100,000 in house value, $700 per month. However, the rent to value ratio has been upended a bit. Guess why? Interest rates are so incredibly low that rent to value ratio is not nearly as meaningful as it used to be. So it's different now. you can go much further down in rent to value ratio and still have an asset that performs really, really well. You don't need to get 1% or even 0.7% now, because the cost of the debt service of that mortgage is so incredibly low that, it's the rent to value ratio is just not as meaningful as it used to be. So I hope that makes sense.
We have another comment from Giuliano.
Well, while you're looking at that comment, I want to give everybody a view of Tampa Bay here.
Oh yeah, very nice to see.
It's nice out there, and there is the nice view of Tampa Bay.
Oh, it's gorgeous! Wow, look at that.
So
great
it's
city.
it's not the most gorgeous body of water in the world, but it's pretty nice. And the sunset's right there. I got some. I sent you a great sunset shot the other day, Ashley. Remember that one?
Yes, yes, beautiful. So Giuliano just commented, maybe he means rentals versus owner occupied markets. And I think maybe that's what Robin had intended.
Oh, well, yeah, I don't know what that means.
If it's a rental dominated market or an owner dominated market. But Ramin, write in the comments what you meant. And then,
yes. If you want further clarification, just let us know. Make another comment there, and be sure to hit the like button, everybody. We can see a lot of you are watching right now, but please hit the like button for us. We have to be slaves to the algorithm. Okay. So
we're all slaves to the matrix. There's no going back now. There's no going back.
Ashley, one more thing I want to say on that rent to value ratio issue is that remember, it is called the rent to value ratio for a reason. Notice that it's not called the rent to what I paid for it 10 years ago ratio. It's the rent to value ratio. The reason is that the current value is so critically important because it represents an opportunity cost. So say, for example, you paid $100,000 for the property and now it's worth $200,000. And you're still calculating your rent to what you paid for it ratio. And you're thinking, oh, I'm getting $1,000 a month. That's great. No, it's not great. You are losing money because that additional $100,000 equity that you've earned in that property represents a huge opportunity cost that you could be investing into, say, another property where you increase your income. So very, very important. It's not called the rent to what I paid for it 10 years ago ratio.
Nice.
Rent to current value. Okay. Don't forget that.
Okay. Electric Kitty. I love that. I love that name. Electric Kitty 1129.
There you go.
Kitty. Hello, Electric Kitty. How do you get past the fear of being a landlord?
Well, let me quote a great quote. We have nothing to fear but fear itself. Was that Roosevelt that said that? I think it was Roosevelt, right? Anyway, yes, we have nothing to fear but fear. Why are you afraid of being a landlord? What are you afraid of, Electric Kitty? Nothing to be afraid of. It's great. I mean, by the way, in our Empowered Investor Inner Circle, and if you're not a member, join the Empowered Investor Inner Circle, because our next monthly Zoom meeting will be all about my recent, literally as of a couple days ago, self-management experience. 2 properties I just closed on. I got them both leased at really good prices, self-managed, no property manager, no one skimming the profits off the top. I think I got $800 to $1,000 more with the 2 properties than I would have received if I had a property manager, because I was very aggressive on the rents, and by golly, got them both properties leased. They started October 1st. So the tenants just moved in the other day. I'm going to tell you the good, the bad, and the ugly. I'm going to share my screen. I'm going to show you my software that I used for that. I'm going to show you how I got all these applications, how I chose applicants. The Empowered Investor Inner Circle, super important. And Electric Kitty, if you're afraid of being a landlord, this will help you overcome that fear. So go to empoweredinvestor.com, and join us. We have a whole community of people there to support you. We have monthly Zoom meetings where you're going to get the roll up your sleeves, the nitty gritty, get your hands dirty, get in there and really see, how it's done very specifically. So empoweredinvestor.com.
So when is your book about the art of negotiating going to come out? Because I think everyone would buy that here.
I don't have a negotiating book coming out.
Well, you should. Well, you should. Just
I tell you, yeah, people always say I'm really good at that. So I could definitely do a book on it.
Okay, let's have another question. Another question from Ramesses Goucher. I'm so sorry about my pronunciation.
What number?
1130. With the current macroeconomic climate, is there reason to be discouraged from flipping in the Midwest, Indiana? I try not to be the crash is coming guy, but don't want to be caught holding the bag.
Yeah, that's a really good question. So first of all, I have noticed, and I've done, flips before many times. And, of course, we deal with flippers. They supply inventory to our buy and hold investors. I've always noticed over the years that the people who flip properties have spending money, but the people who buy and hold properties have real long-term wealth. So I really encourage you to focus on building a long-term buy and hold portfolio over flipping. And one of the things a lot of people don't realize with flipping is, other than the fact obvious that it takes a lot of work, that you are speculating to some extent. And like you said, you don't want to get caught holding the bag, because the game of musical chairs, eventually it stops. They take away a chair and you got no place to sit. Okay. And you're out. So that can happen. And it does happen to flippers quite often. With flipping these properties, but the other thing that people don't realize is that they have a huge tax bill. So, the tax collector is going to take a third to half of that money as you flip. When you buy and hold, you don't get a tax bill. Even when you sell your properties, like me, I just acquired those. I acquired 3 new rental properties recently. One, I made a little video. I was there yesterday, so I'll put that on my Facebook page, maybe on the YouTube channel as well. I'm closing on that one tomorrow. But the other 2 I just closed. I've been doing 1031 tax deferred exchanges. I pay 0 tax, and I get to reinvest all of my profits back into the new properties. And I just started a 3rd 1031 exchange this year. So I'm going to complete 3 1031s this year. I've been moving some stuff around with my portfolio, and it's just beautiful. You pay no tax. The tax man just steals your wealth. And when you flip, you are just paying a huge tax bill. When you buy and hold, you get tax advantages. So I really encourage you, and you may well be doing it. So, I don't know whether you're doing that or not, but I really encourage you, get yourself a nice buy and hold portfolio. Now, the way a lot of people do this is they build a buy and hold portfolio by doing some flips to get some capital initially. If they're just starting out, they do the hard work, which is flipping. That is really hard work. And yes. they use that money to buy and hold. Right. And so that's, that's a good strategy. But if you have the capital, just buy some buy and hold properties. Okay. Don't flip out.
Thank you, Ramesses. Thank you for that question. Okay. 1136.
Oh, and by the way, I do have to say the next comment was this. So you are doing that. Good.
Exactly. Fund our long-term rental goal.
I applaud you. Yes. I'm glad that you're doing that. Absolutely. Good thing, Ramesses. So excellent. Good work.
Yeah. Right. Okay, let's go to Yono Escobar at 1136. So if your returns multiply based on your leverage, what is the healthiest down payment percent on your first personal residence that you recommend as to not over leverage?
Well, the first answer to that is the lender probably won't let you over leverage, because we're not in that time when they were like before the Great Recession, when they allowed people to over leverage. So as long as you are giving the lender honest information as to what your income is and what your savings is, and so forth, right? And as long as that income is dependable into the future, now the future is unknown, of course, but if the likelihood is good that that income is reliable, it's unlikely that you could over leverage even if you wanted to over leverage. The lender will not likely let you make this mistake. But all that said, can you afford the monthly payment comfortably, right? Can you afford it? Do you have money saved up for an emergency fund if you get into problems, right? You don't want to save too much because that money's not working for you. But do you have, 4 to 6 months, or if you're more conservative, a year worth of expenses so you can live if your income stops, right? I'd say a year is too much. You don't need that much money. It's going to be too much money not working for you. Okay. So that's the first thing. But I would really try to use as much good quality, low cost leverage as possible. So if the lender will let you do 90 or 95% loan to value, and you can truly afford that, I would do it. And if as long as it's a long-term fixed rate loan, I think you're wise to use the leverage. One of the things I've said for many years is that the best insurance is a high loan balance. And I know this is counterintuitive. I completely understand this is counterintuitive. And some people who haven't followed my work are going, "What are you talking about? Are you crazy?" No, I'm not crazy. I know what I'm doing. I've made lots of mistakes, and I've seen a lot of clients make mistakes and have successes. And think about it. If economic problems come in the future, which they inevitably will, right? There will certainly be a recession at some point. And if you have to default on your loan because you simply can't make the payment, if you have a low loan balance, the lender is going to look at you as a foreclosure target. Whereas if you have a high loan balance, the lender is more likely to work with you because they know that there isn't padding in there, that they need to work with you. It's in their best interest to work with you and help you with a loan modification or a short sale or a workout of some kind so that you can get by and you can either safely sell the property or keep it. But if you have a low loan balance, they have no interest and no incentive to work with you because they know that they could foreclose, and because of all that extra equity there is in the property, they're going to be protected by that equity upon a foreclosure sale. So the best insurance, oddly, I know it sounds counterintuitive, but really investigate it, is a high loan balance.
Okay, let's circle back Jen Psaki style to Raw Means question. 1146 Raw Mean has clarified. I actually meant rent to owner ratio.
Well, what does that mean?
So the original question, let me go back. What are your thoughts on rent to owner ratios when evaluating rental markets to invest?
Sorry, didn't get that. Okay, so let me find the question. Where is it?
So the original question is 1112.
Yeah, I got that one already, right? But 1146, I don't see it. Anyway, okay. So if you mean tenant to owner ratio, that's really what you mean, okay? In a neighborhood, for example, if you've got a neighborhood of 100 houses, how many of them are renter occupied versus how many are owner occupied? If that's what you mean, that's a totally different question. So sorry if I missed that, okay? Only one cup of coffee so far this morning. So that's my excuse. I rely on coffee to think. And I'm not saying that's a great thing, but it is what it is. Anyway, this is really hard to tell. It's hard to answer. And I'll tell you why. Because as you probably know, there are build to rent communities now that are 100% renter, but they're single family homes,
Yeah.
which really was an extremely rare thing before, say, 2010. And now it's becoming extremely common. So a lot of communities have a high tenant percentage, a high renter percentage in them. So it depends. Is there a homeowners association that is going to make sure that neighborhood is kept up nicely? Is it just a neighborhood with pride of ownership in general, right? There are many factors there. But I can tell you that a lot of home builders will limit the number of investors who can buy in their tracts to 15 or 20%. Now, that's anecdotal because it's just what I've heard over the years, what they've told me over the years, what they've told our team members over the years, because we contact these home builders and we try to sell their properties to our investors. That's what we do, right? That's one source of inventory for us. There are others. But that's what the home builders will tell us. They'll say, we have a limit of only 15% non-owner occupied in this development, or 20% non-owner occupied. But it could be anything. They can just change their mind tomorrow. There's no regulation on this stuff. They could say, well, tomorrow we only want 8%, or, it's fine if they're all non-owner occupied, or, 33% could be tenant occupied. It's just, they could just change their mind tomorrow. So just understand that.
Okay, let's take a few more. There's some great.
And by the way, Ashley, we got to wrap it up.
Okay.
We're
all right.
Let's see. But let's get a couple more in.
Two more. Okay. So 1146 from DL. And
Ashley, by the way, you know what? The title was it wasn't your idea exactly, but you inspired the idea of the paint.
Oh,
so
yeah.
Before we go, we've got to at least address the title of this live stream.
Oh, of course. Yeah, no, I was, it's been going on for a while, the paint shortage, but it's worse. I think it's
way. All right, so question 1146, but which person? There's a few.
DL, from DL.
Okay, there's DL.
Yeah, how much more are you paying for properties now versus what you paid for a similar home value 5 years ago?
Oh gosh, DL, that's a tough question, because here's the issue. That really is much more complicated than it might sound, and I'll tell you why. One question, probably what you're thinking, is how much has the house appreciated, right? That would be how most people would probably think of that. And the answer to that question is it depends where, right? But these houses are a lot more expensive than they used to be in nominal dollar terms. But in real dollar terms, they're actually cheaper in many cases if you look at the Hartman comparison index. And the payment on them is cheaper than it was 5 years ago in many cases. Okay, that's the first thing. Then the second cut to that, or we'll peel an onion. Okay, the second layer of that onion as we're peeling it is it which market is it, right? So there's about 400 MSAs, or metropolitan statistical areas, in the country. There's over 3,100 counties, and I don't even know how many cities there are. By the way, Ashley, find out how many cities there are for us, and we'll talk about that the next time we meet. Because I don't even know how many cities there are in the U.S. I got to find that out. But you can break them all down into three major types: linear markets, cyclical markets, and hybrid markets. So the cyclical markets, when you have an upswing, right? And I got to stay in the screen here. That's the graph, right? That's the upswing. When you have an upswing like we've had over the past few years, because of these crazy low interest rates, the cyclical markets will have very pronounced appreciation, but it's kind of a sucker's bet. And the reason for that is that when things contract, they will contract a lot faster. The cyclical markets will. Higher highs, lower lows. Linear markets, the ones we like the most, just kind of chug along and do their thing. They're very dependable. It's like a wife versus a mistress, okay? The wife is good and dependable, and the mistress, you never know. right? And so that is the way you got to think of the linear and cyclical markets. So the cyclical markets have appreciated more, but the linear markets are reliable. When the contraction happens, it will not be so pronounced as it is in those crazy cyclical markets. Okay. Then just one more layer I'll give you to that. What homes are being built? What quality and what level and what price segment is being constructed? Well, home builders are literally just not building the same home as a general statement. Of course, there's going to be an exception here or there. But generally speaking, builders are not building the same home they built 5 years ago or 6 years ago. They're building nicer homes. Why? Because they can get a bigger margin on the nicer home. So, like anything, it's a complex question. These things are never as simple as they look on the surface. But for the most basic first question, circling back to that, yes, there has been appreciation. It's very significant. How much? Depends where, depends on the price segment of the house, the housing style, depends on a lot of things. But the answer is, in nominal dollars, significantly more. In real dollars and comparison to other measuring sticks like gold, oil, S&P 500 shares, et cetera, the price, and many times it's cheaper than it was then. And in monthly payment, it's way cheaper in most cases. So is housing expensive or cheap? If you look at it in a really analytical, knowledgeable way, and you use the Hartman Comparison Index, it's cheap. Still, it won't be cheap forever. At some point, there will come a time when it will look expensive. And the Hartman Comparison Index, the HCI, will say, housing is expensive, red lights flashing. That day will come, I'm sure of it. And we'll tell you when it comes.
Right. So the HCI is really focusing on house buying power as opposed to affordability, because they're not the same thing. House buying
power. That's an interesting statement.
The purchasing power, I guess. House buying power. Yeah.
Well, because that is affordability. Ashley, I would argue that is affordability. Because now it's not the same as, you're probably thinking of the Housing Affordability Index, which we talk about, published by NAR, the National Association of Realtors, and that looks at median income in a given area versus median mortgage payment. And it's not a bad index. It's my third favorite, but it's not enough information. The HCI is better than that. And actually, I know you today wanted to talk about my second favorite index, which is the First American Index, RHPI, the Real House Price Index. I don't think we're going to have time for it, but
next time. Okay, should we take just one more really quick question and then wrap it up?
One more question, and then we'll end with paint.
And with paint, okay. 1148. Pudoewa.
Boy, we're getting some really tough to pronounce names.
I had to laugh at myself. Yeah.
For our sake, you got to put in a pronunciation key for your name if it's hard to pronounce.
No, they just want to laugh. That's okay. You can laugh at my expense. I'm totally fine with that.
I'm looking for it.
1148.
Oh, there you go.
Here we go. So everyone always says when you gain equity in the property, it's an opportunity cost and you should pull it out. But no one mentions the risks. Can't you create an alligator and start losing money?
Oh, good question. Yeah, good question. Well, an alligator, by the way, let me explain what income property investors call an alligator. An alligator eats you, right? I live in Florida. I know all about alligators. Okay, and when a property becomes an alligator, it is eating you alive because it's eating your cash flow. It's got negative cash flow. That's called an alligator. Okay. And you could create an alligator potentially, but that's actually kind of unlikely. If it's a lower price property, even if you refinance and pull as much cash out as possible at today's low interest rates, it's very unlikely you can create an alligator. You'll probably have positive cash flow, and the lender probably won't even let you have negative cash flow. They won't even qualify you for that loan. Okay. So the likelihood is very low. But even if you could, I would argue that you could better use that money outside of the property than you can use it inside of the property. Just remember one principle I've been teaching for many years. Income property is the most historically proven asset class in the United States, or well, in the world. It's the most debt-friendly asset class in the United States. It's the most tax-favored asset class in the United States. And as such, it's a great asset class, but it's not a very good bank. Using your properties as a bank is rarely something you want to do. I did do a YouTube video on this. It's an older one. I did it about maybe 2 years ago. I was on the deck of a cruise ship. And I think the title of that is, When Should You Pay Cash for a Property or Pay a Property Off? There are very few times where that makes sense. It probably doesn't make sense for anybody watching this right now. But go check out that video on my YouTube channel, and you can get about a 10-minute explanation of that, I believe. Okay.
What cruise ship was that? The Titanic?
I wasn't around in 1915. Yeah. Isn't it interesting that the Titanic sank with all that gold? The Federal Reserve was created and the IRS was created all right around the same time. Just a big coincidence.
Sounds like a great topic for a book. Some research there. All right, so the paint debacle, basically, it's just another thing on the never-ending list of shortages. It's everything shortage.
Do you have a slide for that?
No, I don't.
Okay.
But I have a quote from Sherwin-Williams CEO John G. Morikis. He says, the persistent and industry-wide raw material availability constraints and pricing inflation we've previously reported have worsened, and we do not expect to see improved supply or lower raw material pricing in our fourth quarter as anticipated. So it's just going to get worse. So if you need to buy some paint, get it now before you can't get it at all.
Okay, so Ashley, thank you for sharing that, and that's really important. Remember, if you've been following my work for a while, folks, you'll know that I teach a strategy called packaged commodities investing. And what that means is when you buy a property, you're buying two major components, land and improvement, the house sitting on the land, for example. And when you buy that house, that's a set of commodities that are assembled commodities, packaged commodities. And they include what Ashley said, paint, right? Copper wire, paint, concrete, lumber, petroleum products, glass, steel, all of these things, right? One of them is paint. And paint prices have gone through the roof as these shortages have occurred. So any house you own now that is painted, and I venture to guess that's every house, okay, is painted. Any house you own now, paint is one of those ingredients. So congratulations, when the price of paint goes up, the price of your house goes up, quite literally. When the price of copper goes up, all that copper wire in those walls becomes more valuable. When lumber prices go up, when the cost of any material goes up, it puts upward pressure on every existing home because it is made of all of those components. So, Ashley, I'm so glad you brought that up. Good point, good point. And paint, like so many other building materials, has just skyrocketed in price and value. Remember to enter the contest, go to jasonhartman.com/contest, make your quick video. It's super easy. Also get our free book you see scrolling across the bottom of the screen at pandemicinvesting.com. Some of my strategies adopted for the crazy world we live in now. That's available at pandemicinvesting.com. And then the contest, jasonhartman.com/contest. You got 7 more days on the contest to win some really good prizes. And again, I want to remind everybody, the odds are very good.
Yes. Take some inspired action and enter that contest. Yes.
Absolutely. All right, Ashley, thank you so much. And thank you, everybody, for joining us.
Thank you, everyone. Have a wonderful day.
See you next time. Happy investing.